This is why we said what we said at the top of the show. As you see right now, the Dow is up 59. It's lost more than 300 points of its gains. And you see the S&P is negative now, down 6. NASDAQ is also losing steam. We've got a showdown here. One of our guests says it's bonds. Another says, no, it's not. Let's get right to the debate. Our equity guy, John Lynch, is here. He's chief investment strategist at LPL. And defending the fixed income side, James Bianco, president of Bianco Research. James, what is going on? Why have we just lost nearly all the gains?
Because interest rates are still up at 285. We started this whole process a week and a half ago. Interest rates were rising because the market is afraid inflation is going to return. Interest rates only fell on Monday when they were freaking out that the stock market was coming unglued. Now the stock market is stabilizing. We're right back at 285 on the 10-year yield, and we're right back to where we were late last week. Interest rates seem to be putting pressure on the stock market.
James, go for it. What do you think is at work here?
Do you mean John?
I'm sorry, John. Yes, go ahead. James, John, go ahead.
Well, good afternoon. I think James makes a really good point. Once the 10-year essentially stabilized, if you will, in the 270 to 280 range, that's when, you know, the massive sell-off on Monday started to stop. But I think what investors need to appreciate is that you can't have a V in this. It's going to be more of a W or be more of a process. I think we saw capitulation certainly on Monday from selling pressure, but look at what happened yesterday with the 1,200-point round trip, and today we've done a major round trip as well, and we've seen capitulation, if you will, from volume. I think we've seen it on 20-day lows, but we've not necessarily seen it on advanced decline line, and just the fact that we lost 200 or 300 points over the last hour, I think is just another example that it's going to be a process. Ultimately, we believe that these things will settle down. I don't think you're going to see that sort of move in rates going forward. I think the wage scare from Friday, I'm not sure that's going to be sustainable.
Can you imagine that we're calling a
gain?
Get
more comfortable with Jerome Powell.
Yeah, and we're calling a gain in wages we're calling a gain in wages a scare. No, we saw wages rise 2.9%. James, we're running up against the clock. What would you buy to put sort of a protection in the portfolio?
I would buy puts because I think that this process is going to take a little bit longer to unfold. The biggest problem is the market, for the first time in the post-crisis period, fears inflation. If that's the case, central banks are way too easy. They're going to have to pull back hard, and that's what's unsettling the stock market. And then you throw in a derivative scare, and you got what we have.
John, 10 seconds. We look like we're about to go negative. We're only up 7. What would you buy here for your portfolio?
We're in the process of repositioning portfolios from growth toward value. We're looking for beneficiaries of the recent tax cuts, and we're going to build positions in industrials, financials, and to some degree technology as well.
And there it goes, negative. The Dow just lost 381 points of gains like that. You could say volatility is not in the rearview mirror yet. Thanks to James Bianco and John Lynch. That'll do it for the Claimant Countdown.